Hello, everyone. Welcome back to Matt's Musings. Apologies, I've been away. Had a few things come up and a bit of health issues, but hopefully back to it in a partial capacity going forward. Today, I'm lucky to have Ash Craig with me, a professor in tax at Australian National University. Ash is a great guy and very thoughtful, and I think it's a really fun interview. I have a couple of other interviews with ANU academics, which I'm looking forward to putting up. I'm just putting this one up first, given how topical it is, as it's on capital income taxation. It does sound like I'm in the toilet while I'm doing this interview. Future interviews won't sound like that, but this was just recorded on the move. Now, I'll pass over to the interview. See you all soon. Welcome back, everyone. I'm extremely excited to have Ash Craig from ANU with us today to educate us on capital income tax. Now, I've been wanting to chat to Ash for ages about tax in general. He's one of the main tax experts in Australia. And we previously had Stephen Hamilton on, and we had Stephen Hamilton debating Richard Holden on as well, which was really great. And Ash is right up there in terms of really being top of the game to talk about tax. I think it's really valuable to learn from people like this and to think about topics that are ongoing. Now, we've picked capital income taxation because there's so much debate about it at the moment, but we won't so much probably be digging into the specifics of that debate as much as trying to form principles and ideas that help people to understand the trade-offs that are being debated. So how's it going, Ash?
Going great. It's a great time to be a tax economist in Australia. And lots of good people to talk to, like you.
Yeah. Well, tax is a beautiful thing. As we say in New Zealand, tax is love. So when we talk about this idea of capital income, it's something where I think everyone's a bit too embarrassed to admit that they're not really sure why a capital is being put in front of this thing, income, or that the idea of what an income is can even be really that confusing. So could you sort of tell us, what do we mean by capital income and income more generally?
Yeah, that's a very interesting question. On the surface, sometimes it seems like that should be a very easy question to answer. Like we kind of have a sense of what income is, right? But the more you think about it, especially when you think about labor and capital income, the less clear that gets to some extent, and it gets quite contentious. So I guess I'll start from the theoretical world that we tax economists live in, and then we can get more practical as we go, because it's actually easier in the theoretical world to see some of the distinctions than it is once you actually start thinking about real businesses and savings decisions and things like that. So the way we tend to think about it is that people, first of all, they need before you can save and invest and get a capital income, etc., you need to actually get some income in the first place. And so you work, whether it's for an employer or otherwise, you dedicate some hours and you earn some return to that for your, as payment for your hours. And we call that labor income. And some people have very high rates of return on labor effort. In other words, they are high income people. And we tend to tax them more than people who have much less labor income because we want to redistribute from richer people to poorer people. Or put differently, we think that if we want to fund government expenditure, etc., that it's the people who have an ability to pay for that because they have a lot of income that should be funding that. All right, so you earn some labor income and then you end up with some dollars in your pocket, and then you can either decide to consume them now. You can go out and buy goods and services and get a high level of well-being, whether it's renting a fancy house. We can think about buying a house that gives you consumption in the future too, but that's more complicated. You can go out to nice restaurants, you have to feed your family, etc. So you can consume stuff now. Or you can set some aside, and obviously you do some of both. And if you set some aside, you can then consume in the future. And because people tend to prefer to consume more stuff now rather than in the future in general, it's cheaper to consume stuff in the future. If you put some aside, then it grows. That's one way of thinking about it. And One way of thinking about it is you earn interest or you earn a return on shares, whether it's in dividends or capital gains, etc. And then you can buy more goods and services in the future than if you just consumed it right now. So there's this kind of return to earning more in the future. So there are kind of two different decisions here, which is helpful in thinking about whether or not labor income or capital income should be treated the same or different. One is how much you work, so how much effort you put in, how much money to get in the first place. And the other is when to consume. Do I want to consume now when consumption is relatively expensive? Or do I want to consume a long time in the future when it's cheaper because basically I can put money in the bank and it grows and I can afford more given the same amount of money that I put in because I earn some return on that. So one is a decision of when to consume, and the other is how much money to earn in the first place. So what we think of as labor income. And the way we tend to think about that in our simple theoretical world is the choice of when to consume is very much like the choice in a given period, like today, of what to consume. So I could decide to consume, I could go to a really fancy restaurant and I could eat a very small plate of food that costs a lot of money, but it's amazing. Or I could go to a cheaper restaurant and I could get a whole mountain of food that actually lasts me a week, and it's not as fancy and delicious as the one at the fancy restaurant, but I get a whole lot more food for it. So that's one choice. Or and similarly, I can decide, there are kind of two goods: there's consumption today or consumption tomorrow, and there's some price difference, and the price difference is the return that you would make in between those two periods, the interest rate. So it's actually a very different type of decision. And if you think about it like that, it's not at all obvious why you should treat the so-called income from savings, which is really just like a price difference between two different consumption goods, the same way that you treat labor income. In fact, you can kind of see the way I framed it as a choice over different consumption goods. If I'm in a given period, I think everyone basically generally agrees that it's a good idea to have a GST that is flat across all consumption goods so that there is the same tax on every good and I don't distort your decisions over what to consume. Well, you can use the same logic to say, well, I shouldn't distort your decision over when to consume. But that is actually an argument for not taxing interest, dividends, and so on. And it gives you an argument for not taxing capital. Now, I'm not necessarily advocating that we shouldn't tax capital. I think there are good reasons to that, but that's kind of the baseline way of thinking that we have in mind here. So at the very least, you can see that they shouldn't necessarily be treated equally. But then you can start talking about, okay, it may not be as simple as that world. What is then different? What reasons do we actually have to tax capital and savings and so on? And does that motivate a particularly high tax rate? Does it motivate a tax rate that's similar to labor income? Does it motivate a progressive capital tax rate? All of those are kind of interesting questions once you have the baseline ideas in place.
I know, so that makes a lot of sense. So when we talk about this concept of income, people are saying, oh, it looks like there's a return you get from your savings. You receive interest, you receive dividends. Maybe there's a capital gain that is accruing or that you've realized, depending on how you want to talk about it. And at a point in time, it looks like, oh, that's some sort of return from a factor of production. That's nice. And then your labor income is also a return from your factor of production. You're going and you're sacrificing time and earning income. So when you're just sort of walking around, it feels like, oh yeah, we should be taxing those things the same way. But the way you're recharacterizing it there is essentially saying we sacrifice some time to work. That leads us to then want to either consume that income now or save some of it, which is where we build up that capital factor of production. It accumulates. And then that requires some return in order to maintain its value in terms of things we can consume in the future. So I think that's useful for sort of breaking apart some of the what I would call like tacit intuition about why labor and capital are just the same sorts of flows, when in reality they're measuring very different things. And what I think is important there is a lot of the discussion about we really want to tax consumption the same way, irrespective of when the consumption occurs. So why don't we just have an expenditure or consumption tax? Why do we tax income and as a product tax some of this, compensation for consuming in the future, why do we do that at all?
Yeah, well, that's a good question. I think you get a different answer from different people and even from different economists. Or I think was a US president that I can't remember the name of said that what he really wanted was a one-handed economist, because every time you ask an economist a question like that, they say on the one hand this, on the one hand that. And I'll probably give you a bit of the same answer.
Way to do it.
Okay, so just to think about empirical facts for a moment. I mean, one tempting reason why you want to go after capital income and why you might intuitively want to have a high tax rate on it is that richer people in kind of all senses of the world of wealth, of capital income, and of being, I think, high labor income over their lives or having rich parents, etc., tend to have a lot of capital income. It's extremely concentrated. And so that makes it a very easy, it's a nice target to say, okay, if I want to redistribute between people who are rich to people who are poor, capital income is just more unequal. It's more concentrated at the top and there's more to grab and redistribute. And another reason it's tempting is that that's kind of the way economists say it, it's kind of sunk. The decisions that produced that wealth, etc., are all in the past. And anytime someone's accumulated a bunch of wealth, it's very tempting to say, well, I want to take it and I want to give it to the people who are needier. The problem with that is, of course, that if you can do that once if you really genuinely surprise people, but if people anticipate that you're going to do this in the future, then next time they just won't accumulate that wealth in the first place, or they'll accumulate it in some other jurisdiction overseas, or they'll leave the country, etc. And so you worry about those types of responses. Now, and then if you say, okay, so I want to get these relatively rich people and take some resources from them, you can then ask, well, what's the best way of doing that? And one way is to actually tax capital. So you tax the savings of rich people and the returns to savings. Another way would be to say that those people accumulated all those resources and decided to invest and save and earn those returns because they had a large amount of income that they earned in the labor market in the first place. So we could actually not distort when they consume, get rid of the capital tax, and just tax those rich people who accumulated that income in the first place instead. So you basically have a more progressive labor income tax system without distorting when to consume. Now, this is where it gets into kind of nerdy optimal tax economics. So in a simple world where if you imagine that everyone actually has the same overall preferences over when to consume, right? But they differ in their ability to earn labor income. And so the only reason that kind of rich people have lots of savings, etc., there are kind of two reasons. One is that they have a lot of income to save in the first place because they had higher labor income earlier in their lives. And the other is that once you have lots of labor income, you can save a bunch of it. And rich people tend to save more in general than poorer people. Well, if everyone has the same preferences over when to consume, then actually the efficient thing to do is not to distort when they're consuming, have no capital taxes, but just tax those people who are earning that when they're earning that high labor income in the first place. That's the efficient way to actually tax these things. You can get away from that in several ways. One is if richer people are different in some fundamental way. So it's not just that people save more when they're rich, but there is something about rich people, whether it's where they grew up and their preferences or their upbringing or whatever it is, that makes them more patient and therefore more willing to save, or means that they have opportunities to invest and earn higher returns than other people would have because of, say, parental connections or their private school or whatever it is. If those types of things are true, then it gives you a reason to tax capital specifically. Another reason to tax it is that I've made out through all of this so far that it's really easy to just say, I can look at this income and I say that's labor income and that's capital income. Actually, in practice, that's extremely difficult. It's difficult both in practice, but even conceptually. So in practice, if I start a business and to produce, I have to build a factory and produce widgets. And that requires a year of labor effort from me, of really intense work, and it requires $1 million to set it up. And I can't do it without either one. Is that labor income or is that capital income? I don't think there is a clear answer to that question. So even conceptually, that's hard to answer. And then in practice, people start a business and it's very hard to work out whether what they're producing is a function of their labor effort or whether it's the savings that went into the business, etc. And so if it's really hard to distinguish those different types of income, then you can't really tax them differently. And so it's going to start to push you toward having to have equal tax rates, because otherwise, if you have a really low capital tax rate, then everyone's going to start these businesses and they're going to disguise their their labor income as capital income, and they'll get the low tax rates, even though that's not what you intended. And so it does give you this force toward having somewhat more equal tax rates then.
That's extremely, extremely useful. And I think that a lot of the tensions you talk about are also realistically the things that we don't hear them when we hear in public, but people at the ATO and within Treasury will be debating with each other when they talk about what advice they're going to give on talking about these tax instruments. And then it comes out in public through this filter of how do we explain what's going to happen with a tax, and how should things be communicated and talked about. Now, when we see a lot of this happening, one thing I've noticed from Australia and New Zealand, and you don't see it as much overseas, although it does in some sense come from a lot of the discussion in the US in the 1970s, this discussion of taxing comprehensive income, and that we should tax, sometimes people talk about Haig-Simons income in of itself, and they'll often say, well, given that motivation that we should tax comprehensive income, a dollar is a dollar, and we should tax it the same way. Now, the way you've described things, we really shouldn't be taxing a dollar as a dollar. A dollar you get, which is actually because you are earning it as a return from savings and it's coming from deferring consumption, that dollar is also including a bunch of compensation for the fact that you're deferring consumption. The fact there's inflation, the fact that, you have a time value of money and the such. And so the dollar for dollar thing, it might be a communication device, but I don't think it's truly what Treasury and the ATO and a lot of people talking about these issues would mean. But then when you point out the idea that, if it's actually labor income that's cloaked as capital income, in some sense, a dollar would want to be taxed as a dollar in some way. When these ideas end up being communicated, what do you think gets missed a lot in terms of how we need to be careful about this design? And how do you think the Australian tax system functions in terms of, does it overtax certain types of capital? Is there an appropriate allowance being given for the way that there's this time value of money, et cetera, et cetera? Where do you think that there is flaws in policy because of the way it's being understood at present?
Yeah, all right. There is a lot to that question, so I'll pick and choose different parts, and we can iterate a little bit. All right. So as you said, there is this long-standing definition benchmark of income, the Haig-Simons definition of income. I have many issues with that definition, but I'm just going to kind of deal with one thing at once. The basic idea there is that you should take all of the income that is paid out in the form of wages and dividends and capital gains, and in fact, even unrealized capital gains, and count that as income. And you should treat, according to this Haig-Simons benchmark, all income the same way, regardless of how it is earned when you define it in that way. So you should tax unrealized capital gains in the same way as you tax wage income. So I think it's fairly clear from what I began with that, at least in the simplified world of optimal tax models, that's very hard to justify. Because they're completely different decisions. One is about when to consume, and one is about how much labor effort to put in. And there's just no reason built in at all why those things should be treated in the same way. I think that, like you said, the only kind of compelling reason that I see for them to be treated equally is that you actually can't tell the difference, and so people can substitute easily between them. So the more that is true, then the more I'm inclined to think about, you wanting to actually harmonize the way that the different types of income are treated. The less it's true, the more I think that there's just no compelling reason to treat them in that way. The other problem with Haig-Simons is that and therefore the idea of a comprehensive income tax in that idealistic sense, is that it is not really tied to efficiency, for one thing, because we already talked about how it might be more efficient to, instead of distorting when to consume as well as how much money to earn, you could just distort how much money to earn without distorting the when to consume. So you have one less distortion. So you tax labor income, but not capital income. That's kind of the efficiency benchmark. Then you could ask, well, does it get at some kind of normatively interesting thing? Is it fair? And that's not obvious to me either. So, one example that is worth thinking about is unrealized capital gains. So if you're going to think about Haig-Simons as the income benchmark and you want a comprehensive income tax, then you should be taxing unrealized capital gains at the labor income tax rate. But if you think about it more, it's not at all obvious that an unrealized capital gain, the way we would measure it, actually corresponds to any type of welfare gain for you as an individual. So there are a couple of different examples that you could see. One is, suppose that I have a house, a company, or, you can think of really any kind of durable consumption good, like a fridge or a car as well. And suppose that the value changes because, for example, interest rates go down. And so the value of my asset, the present discounted value, goes up. And so my company rises in value. But I actually have the same consumption stream throughout my entire life as I had before. There is no meaningful sense in which I'm better off. And so I just don't understand why, normatively, we would want to go after that income and say, well, this person is better off, so we should take a fraction of the amount that he's better off by. But he's not better off. And so there's just there's a disconnect between kind of the normative justification for comprehensive income and what I think, the way we would really judge levels of well-being. We normally kind of judge it in terms of flows of consumption over your lifetime, and then you might take into account flows of consumption of your kids if you're altruistic toward them, etc. But the fact that you have some kind of paper gain without any real gain, it's kind of irrelevant. It doesn't mean that you're better off. It doesn't mean that we should tax it. And then digging into a little bit more of what you said, or a different dimension of it, and this is starting to get more toward the recent government reforms. When we think about capital income, we should be thinking about real capital income at a minimum. Imagine that you actually put some money in the bank and then it grows in value, but only at the inflation rate. So that means that I put money in and then I take it back out and I can consume exactly the same amount as I could have before. So again, there is no gain here. Inflation is not a return. It's just all of the prices going up. So we shouldn't be trying to tax that. At least if we're trying to tax labor income and capital income equally, if we decide that that is a good goal, we should at least exclude the inflationary paper gain and just go after the real component. And so in that sense, we're getting closer to that with the recent reforms by the government. The proposed reforms anyway. There are some kind of oddities in the design as well. So if you really take that logic seriously and you say, well, the actual return component is just the real component and you want to adjust for inflation, then if I earn less than inflation, then I should get a tax reduction from that, right? But the way they've designed it, if you gain on one asset and you lose on some other asset relative to inflation, but on average you earn the inflation rate, they'll tax you on that gain, but they won't give you a credit for the deduction. So it's kind of like they've bought into this idea that inflation isn't profit, but only kind of half-heartedly. So that's one concern. Now people then worry, and to some extent this is legitimate, but it's kind of nuanced. If you switch from the capital gains discount to taxing, you having this indexation system, then that gets better at the real component of returns, and then you can kind of tax that. Whereas the capital gains discount is a messy, imperfect way of doing that. Now, what this will do, though, is that if you have a business that basically starts with no actual capital injected into it, like a startup, then they were benefiting from the capital gains discount, and now they're not. And I guess I have two things to say about that. One is that in terms of the benchmarks where we want to tax labor income, but we want to tax capital income at either zero or lower rates, then this is great, because what they're actually saying by saying that there was no capital injected was that my business grew solely from labor income, in which case it should actually, in theory, face the labor income tax rate. But what it does do is, relative to what we had before, dramatically increase the taxes on startups and so on. And we should ask whether or not that's actually a good idea. Do we actually want to raise taxes on these innovative firms, etc.? And if not, then we should think about some way of dealing with that. And another thing to say here is that if we are going to do this indexation we're going to do it for property, we're going to do it for shares and things like that, then really we should be doing it in a bunch of other parts in the system. So interest income, for example. A lot of people who are saving for a house deposit, etc., they don't want to risk that money in shares. They put it in the bank, and you're taxed at the full labor income tax rate there. You never got the capital gains discount, and now you don't get the indexation. And so if we're going to be symmetric and not distort how people are allocating their assets, and you want it to be fair, then we should be doing that for interest income as well. And then on the other side, which I haven't seen discussed much, businesses can often deduct interest. And actually, they should only be able to deduct the real component of interest if we're going to move toward this kind of indexation logic. And that would actually be good for the government's goal of raising more revenue as well. So they should be potentially thinking about doing that. All right, so those are some ideas. You can ask questions.
I think the difficult thing is the 4 points you raised there, I completely agree with. Like, I really need to find someone that will challenge there, but I agree with those 4 points so comprehensively that I can't even fake a disagreement. The thing I will note alongside it is we talk about the idea of like having an inflation allowance there, and I think you're appropriately cagey in terms of saying we've made a view that real labor and capital income should be taxed the same way, and that's the view that's been accepted. There is very much what you've already established, that in some sense we're thinking about present values. And so rather than the allowance being inflation, you could easily argue the allowance being, a long-term government bond rate or some other rate of return allowance that reflects a normal rate of return. And that would be very consistent with the Mireles review recommendation in 2011. And that was, of course, would be applied to all capital income, and would involve a denial of that part of deductions as well. And since they also recommended that not only have the allowance on bank interest have a full non-taxation of bank interest, they also have full denial of the deduction that came from financing through interest. And the way these things wrapped together, as you were saying, was with symmetry. You made sure that if you treated capital income in a certain way on the way up, it would be treated on the same way going down. And I think having those principles out and having them reflected publicly is very strong. And surprisingly, I think the vast majority of economists would agree with the principle and the structure. When in public, it looks like economists all want to strangle each other on this topic. So it's I feel like it's an area where the language often differs more than the actual, like, if we were asked to sit down and write what our ideal legislation would look like, it would look quite similar. Do you think that's fair?
Yeah, I think on the whole, that's true. It's a tricky thing for people to kind of think about clearly. I mean, in theory, economists should be good at this because we're used to thinking about these types of models. But I mean, the gut reaction when you see lots of concentrated capital and wealth income, etc., is that in fact, why stop at equal treatment? We should tax wealth or capital income really aggressively, and, even above equality. But really, the question is, if I want to take resources from relatively rich, well-resourced people, I kind of want to do that in the most efficient way possible. You can think about that in a couple of different ways. One is I want to, for any given amount of resources that I manage to extract from those rich people, I want to harm them the least possible. And so I think a bunch of relatively right-wing taxpayers or relatively rich people who have the income to be taken would agree with that. They say, you want to harm me as little as possible, but, taking a given amount of resources. You could flip that around and say, for any given level of harm I'm willing to inflict on these rich people, I want to be able to extract as much as I can from them, which is to say that I really deeply care about efficiency in how I extract it. And so then that motivates potentially having sharply lower tax rates on capital relative to labor income and kind of moving away from these Haig-Simons ideas. Another reason, just to kind of bring it in here, is that capital income tends to be very mobile. And so if you have high tax rates on it, then it's going to escape, whether it's into trusts or across to another country or to some other form. And if things are elastic, you tend not to want to tax them so much. And so the Merle's review type logic, I pronounce it differently from you, but I don't know which is right.
Probably. I think you're right. I'm terrible at pronunciation.
But the idea is that we're going to go beyond just a credit for taxation, which is, like you said, kind of Haig-Simons-ish, and actually move closer to having a zero effective tax on at least the rate of the time preference component of the return to capital income. That seems very plausible to me that that's a good idea. You could get away from it if you worked out sufficient evidence that creates too much disguising of labor income as capital income or other types of reasons to move away from even that benchmark. But it seems like a good place to start. And I suspect that most people have thought about these issues sufficiently, they would probably agree, at least most economists, that this is a good benchmark. But like you said, the symmetry matters, because if you have this kind of discount, it's not really a discount. It's just basically taxing the real component of returns for property or shares or whatever. But you don't do the same thing on the deduction side. Then you have this ability to invest and you only get taxed on the real return, but you can deduct not just the real return, but also inflation. And so it gives these leveraged investors an unfair advantage in the market. And so it's going to hurt people's ability to buy into residential property and things like that. So actually, I think thinking about these things could be very important. The government so far as I can tell, hasn't pushed that agenda yet.
Yeah. So Nick Garvin at our institute has been doing some work on that, and Christian Gillitzer at University of Sydney has been as well, about the sort of symmetry of treatment of deductions versus taxation. When I see things like negative gearing happening, it feels like a very indirect way of trying to deal with that issue. Instead of doing anything on actually adjusting deductions, saying the inflation component shouldn't be allowed on your tax return, which would be, I don't think it would be that complicated. But instead of doing that, they're just saying, if the interest payment's large enough, we're just not going to allow it.
Right.
The New Zealand experience is sort of instructive of that. They introduced negative gearing in 2019. And what happened there was it was essentially saying you will be given a tax credit for that additional amount, and you can claim it in the future. Since New Zealand has no capital gains tax, a lot of the time that disappeared, but you could claim it if there was future rental income. And that's the system that Australia is taking now. In 2021, New Zealand turned around and denied the entire interest deduction. And the reason for that was they were saying, well, hey, there's no capital gains tax at the end. We're just going to deny the whole thing. And there's a feeling in New Zealand, so it was hard because it was all around COVID, but there's an impression that that first change didn't actually lead to much behavioral change, but a reduction in leverage. The second one did lead to pretty substantial behavioral changes and concerns that was being passed through into rent.
Yep.
And it shows just how delicate all those types of parts are. And the UK has had similar experiences as well. When it comes to negative gearing in Australia, do you think that there's a relationship with your point about deductions, or do you think it's really something quite separate, and it might be worth thinking about treating deductions separately?
Yeah, well, I think, like you said, it's kind of a partial band-aid solution to it, where maybe it helps a bit, although it would probably hurt renters. But kind of the best solution that you can imagine is actually just treating the deductions properly in the first place. And so that would be my inclination. If you don't do that, then even the current move toward abolishing some, at least negative gearing for some people on some properties, doesn't really fix the underlying issue. And so maybe it will lower property prices a little bit at the high end, although that's not entirely obvious, and raise rents as a result, because it's kind of two sides of the same coin. But if you think about it in the interaction of these deductions and the move from capital gains discount to indexation, it can actually easily go the other way. And so I have some analysis that I haven't put up yet with a friend, Matt Lilly, which suggests that actually it's not obvious that it even lowers house prices in the first place. Whereas I think if you move towards symmetry of treatment, then I think that gets much more effectively at these ideas of unfairly advantaged investors over residential property, like owner-occupier homes. And I think that's the benchmark that I want to go for. I want to make sure things are treated symmetrically, because some people seem to have a very strong view in these types of debates that more home ownership is always good. And I like owning a home, but it's not right for everyone. In fact, if you're kind of moving around a lot, for example, then renting makes sense. And I don't really have a view that we should push people one way or another. But I don't want someone to be unfairly advantaged. I don't want to distort the market toward property investors or away from property investors. Property investors are doing an amazing thing of providing places to live to renters who don't have the resources or the ability to borrow to buy their own home, etc. It's kind of both are valid choices, and I just don't want to distort people's decisions about these things. I want them to make them efficiently.
Exactly. And there are preferences. So when it comes to when I reflect on myself, I'm a perennial renter. Irrespective of if I have the resources to buy, I actually value the flexibility a lot. My wife Golnara says that we're both free spirit Sagittariuses. So as value the idea that we won't be stuck somewhere. If we suddenly need to move and do something else, we can do it. And that's how we are. We're pretty strange people, but in some sense, you want people to be strange, and you want people to just be able to make their own choices. Now, I think that's a really important segue into how we think about income tax. A lot of people will focus on the idea of an income tax is introduced and it generates a deadweight loss, which makes a lot of sense, and it will distort choices. What often gets missed is that there's an opportunity cost as well, and sometimes that opportunity cost itself is taxed. So when talking about capital gains tax there, I noticed that there wasn't much being said about things like risk per se, or the choice of investments. When you've got a risky investment and there's like a risk-free investment, you might say, oh, both get taxed by a flat symmetric tax system. And that doesn't necessarily change the risk profile. Like the literature suggests, it might increase risk taking, or you might be incentivized towards the risk taking asset or away from it, depending on risk preference. However, when you lose symmetry,
yes, that's right.
when you're not allowing losses, when you've got a progressive tax scale, that breaks down, and higher rates can become sort of more distortive. So that's sort of where I'm feeling out. But I'm really keen for your views on what elements of that matter, and what's especially important when thinking about risk and tax, because I feel like that's a topic that's getting discussed a lot, but without much of a framework, and it's partially because it's really hard.
Yes, I think it is very hard, but it is an important distinction, I guess, between what you suggested and what I think E61 has come out with in the past, which is that you have a credit for the kind of the normal rate of return, whether that's the government bond rate or some risk-free rate, versus the actual kind of zero capital tax thing where you don't tax capital in the first place, which is similar, except that it differs in how it treats things like risk. And also, as you suggested, my understanding is that if you have a flat tax system and you fully allow losses to be deducted and so on, which is very much not the world that we live in, but suppose that's true, then it doesn't distort the fact that you're taxing these returns doesn't distort your choice over the risk of risk levels between different assets. Although I think and the logic from what I recall is that the investor can kind of attain the same level of riskiness, but it does seem to imply that the government actually takes on risk effectively through its redistribution, and that seems potentially problematic too, right?
There are two parts to it. There's the partial equilibrium part, which is if you imagine that to make the risky choice and you're risk averse, what you're investing in has to provide a higher return to have the same certainty equivalent. But when you tax that, it actually doesn't, your certainty equivalents are being taxed the same way.
Yeah.
It doesn't change your relative choice. And so what Stiglitz found is that leads to you actually making riskier investment choices. But then when you go to general equilibrium, what you're sort of saying with that is, there's this adjustment where there's a change in risk, and then the government provides back an asset with the risk profile so people can scale up their bet to be in the same position as before. And then in that case, an individual can actually have exactly the same bet as they had before, because the government's taking the other side of that bet. And then risk just disappears from being relevant at all, unless you've got a world where there's decreasing relative risk aversion, and so the income effect has an effect on the investments people.
Yeah, right.
Yeah.
I mean, but then, of course, once you introduce non-deductibility on the downside and you have a progressive tax schedule, so the upside is disproportionately taxed, then that's can no longer be true. We're then distorting across different types of assets. And so, I mean, I reserve the right to change my opinion on this, but there seems to be a motivation to actually just have low capital tax rates rather than having high capital tax rates, but crediting for a risk-free return, because then it kind of doesn't distort across different risk classes, etc. Now, as with everything, this is on the one hand. There's also on the other hand, you could put forward an argument for actually taxing risky assets, for example. But let me tell you the type of argument it would have to be and what wouldn't suffice. So if richer people have low risk aversion, so they're closer to risk neutral, there are two versions of that. One is that they have lots of income, and once they actually have that level of income, it's the high income. You have like an income effect on risk aversion and their low risk aversion. That's not enough of a reason to tax risky assets, because basically everyone has the same preferences, and you're better off just taxing labor income, etc., based on the same arguments we talked about before. But if I, as a high ability, high income person, am inherently less risk averse, that's kind of just part of my identity, then this actually gives you a way of redistributing between people who have low risk aversion, which are the high labor market ability people, to other people. And so that's the type of argument you have to make. And it's not obvious that's true. So the benchmark I would say is probably we just don't want to distort across these choices. We let people make their decisions. And there are plenty of reasons, I think, in the economy, if you think about the way we allow people to set up businesses, to where we try and promote risk taking. So that's why we have things like limited liability companies and so on. And so in general, I would have thought we may actually want to encourage more risk and not actually reduce risk taking, at least at an individual level.
So I think a key point there is how much are we actually, when we're observing risk, how much are we sort of taxing risk in terms of what's the average tax rate you expect to pay when you make the risky choice, in addition to what you would pay in a riskless sense. So with someone who's purely risk neutral and we've got a flat tax system and the such, if the risky bet is zero expected return and it's just all noise around it, we don't expect to raise any revenue. The government's just sort of clipping the upside and then paying back on the downside. And so it very much does come from the progressive structure and the denial of deductions. And when we start doing things that are asymmetric, and to my mind, that is the big motivation behind a dual income tax system. And one of the reasons why people say, look, if we've got a capital income scale, there's a reason why we want to be taxing this capital income, but we should be doing it in like a flat rate sense. Do you feel like that makes sense as an argument? Or
Yes, I do. But I'll put a counterpoint, which is to the extent that you're motivating capital taxation based on substitutability between labor and capital income and ability to mask it, for example, then that actually doesn't push toward a dual tax system. It pushes toward a progressive one that at least partially mirrors the labor income tax. And you can see, I think some Scandinavian countries have dual income tax systems, and you can see how they switch the composition of their income when they move from one part of the income distribution where labor income tax rates are higher into another where they're lower. You can see them fiddling around and changing their compositions and masking their labor income, or vice versa. And so, yes, I see merits in the argument. But I think that would be my main pushback. I think to go back to the more kind of technical optimal tax argument of, if rich people are more patient or they have access to higher return investments, etc., and then that's your reason for capital taxation, then again, that argument also pushes toward having a capital tax system that is progressive, because we have a progressive labor income tax system. So I think I'm left with an on the one hand, on the other hand. But there are other advantages to having a flat capital income tax system, a dual income tax system, because I talked about substitution between labor and capital income, but another is that you can use, whether it's businesses or trusts or whatever, you can reallocate income across time periods and people in a way that avoids the high tax rates and and you get access to the lower tax rates, etc. And the more you kind of raise the floor on the capital tax, the less that's going to be possible for rich people to get literally zero tax rates, for example. I find that argument somewhat appealing. I think it's somewhat limited though. So if you think about the 30% minimums, for example. So you might think, well, okay, there's a problem that potentially someone who's genuinely rich is going to be able to reallocate income into the bottom tax bracket, and so they'll get these very low income tax rates. And so we're going to put a floor on that. But they're actually only able to do that a little bit, because if they try to do it a lot, they're just going to hit the next tax brackets, right? And so you're preventing some of this, but it's not really, these floors are not a way of getting at super rich people and their kind of misuse of the system. And the other thing I would say about that type of smoothing is that some versions of this are actually good. So if you have, suppose that I'm earning $50,000 a year, so I'm actually not very high income, but I've been saving my whole life, and then in the form of shares, and then I sell them and I get this big capital gain. I'm going to look rich in that year, and I'm going to be in the top tax bracket. But I'm not rich, right? This is the product of years and years and years of savings decisions, etc. And the extent to which you can smooth that out over time is great. And similarly, I have a stable salary income. I get paid the same amount every year. So I'm always in the same tax bracket. Someone else who had the same lifetime income, but it's bouncing around all over the place because I have my own business or because I just have a volatile job, I'm entering and leaving unemployment, etc. They'll get taxed more because they're bouncing around between the top tax bracket and the lower one, etc. And that seems unfair. So this kind of smoothing is good. And similarly, I want to be able to smooth, in theory, I would argue, between me and my spouse. This is contentious. Where suppose that my spouse doesn't work and I do, our level of well-being and ability to pay, etc., is really at a household level. So we can have the same income, but if it's split between a high income earner and a low income earner, we get hammered with tax. But if we have more equal incomes, then we wouldn't. And so if we want to actually tax people based on their ability to pay and notions of fairness, etc., then these types of smoothing are good.
Exactly. I'm gonna try to make what you're saying sound a bit more contentious, just because I think they're very important points. But the first thing I'll note is if we had a flat capital tax system, then actually this averaging concern wouldn't really matter, because no matter how much you earn, it's going to be that flat tax rate that's paid. So if it's not a minimum tax rate, but instead the whole scale was flat, then we wouldn't have to worry about averaging. Averaging comes from there being a progressive scale. And I think the lack of averaging when we've got very lumpy income is a concern. It does depend why the lumpiness occurs. Something like capital gains and what you're describing, someone earning a very long-term capital gain and pushing them into the top tax bracket. It feels like the annual structure of progression is probably a bit harsh there when we're imagining a progressive system that's more a lifetime progressive system. We're asking for someone that has a high ability to earn over their lifetime to contribute more when we're thinking about this equal sacrifice. So there's a rationale for some averaging there. But exactly as you say, when you put in a minimum, you're reducing the ability for people to average. When you reduce the ability to use discretionary trusts, you're reducing the ability for people to average and people to income split. At the moment, a lot of what people are calling tax avoidance, and yet it's avoidance within the system, it's minimization, hell, I'll call it tax evasion because I'm not a lawyer or an accountant who would spit tax hearing that. I'm sure if
but
anyone,
not an accusation, right? Yeah.
they would have absolutely lost their, you can't say evasion. I remember my days in public service dealing with that. Nonetheless, when they go and change those things, if they're doing it to smooth through time, because there's this view that it should be a lifetime progressive structure, they're moving closer to the ideal and they're doing it in a self-managed way. That's not necessarily bad. The question is, why is our current system not letting everyone else do that?
Yes.
So the inequity comes from the fact that some people are able to and some are not. And we need to say to ourselves, okay, well, if this system should only be individual based, we're not going to allow joint filing, then you can understand why you would clamp down. But if we see joint filing happen, and we're like, well, as a society, we think that actually a household is the income unit generating welfare, the benefit system is applied at a household level as well, other parts of the government expenditure are applied at the household level, why is tax not being applied there? We should think about that coherently and consistently. And so when it comes to things like the change in trust rules and the minimum tax rates, they're saying they're doing it to prevent avoidance, but they're also shutting down what could be legitimate averaging and then introducing a capital gains tax system that itself doesn't involve averaging. That feels problematic to me. Now, the one counter argument I've heard is people who receive a capital gain are benefiting from deferral. So as a result, we're not going to allow averaging. Now, I think those two things are quite separate from each other and they're quite unrelated arguments. But what would your view on that be?
Yeah, so I largely agree. Now, this is going to depend on whether you're really anchored to the idea of individual versus household taxation. I am personally of the view that household level of taxation makes much more sense. It gets better at what I consider to be the level of well-being of kind of the unit that we care about, which is the household. And so being able to smooth is hugely beneficial in that sense. And similarly, we talked about the allocation over time and so on. When I read the budget papers, there were a couple of sentences there when they talked about the minimum 30%. Right at the start of that section, I don't know what page it was, in the hundreds, it basically said, we're making this change, or we think it's important that people are able to smooth out and we want to get it lifetime income. And so the way we're going to do that is, the next sentence, remove people's ability to smooth out across their lifetime. And I was like, what is this? On the whole, I think smoothing is good. And I think if you actually buy into that idea and think about it enough, then you want this type of either averaging or some kind of the use of trusts is another way of doing it, etc. You want people to be able to do this. I mean, there are other ways of doing it. You could actually move formally to a dual income, so not a dual income, but a household level income tax system like the US you can actually pick, but basically you're taxed on the household level of resources. Now, that lets you reallocate income between spouses, so you're taxed on the household level of income. It doesn't let you reallocate across periods. We do let some people do that. We let farmers and performers, I think, smooth taxes out in those ways. I think those are the two groups. There's no particular reason, as far as I can see, why anyone shouldn't be able to do that. I mean, a very contentious argument building on your idea of fairness because of lack of access is, well, some people are able to do that. This is easier for people who have businesses, so corporate structures, and maybe rich people have more of an ability to set up these trusts, etc., because there are some fixed costs involved or something like that. Well, then maybe we should actually provide a free trust to every Australian and let them do it. If you want to deal with the inequity, but you like the smoothing, then actually give everyone one of these things. And in some sense, we do that to some degree with super. It's basically a kind of a trust vehicle, right? But this would be expanding that role even more. And it's not like the richest Australians are going to be able to, milk this and get lots and lots of resources out of it, because if you're genuinely really, really wealthy and you're gonna exhaust those low tax rates super quickly, and you're going to enter the top tax brackets again. So yeah, there are many ways of getting at this, but on the whole, I'm amenable to the idea that smoothing is good.
Yeah. No, that makes a lot of sense. And it brings us to an idea that I think is worth talking about as well. GST rates in Australia are low, and the base is actually fairly limited. So, GST sounds like an entirely different tax than an income tax. Would you be able to explain sort of why, like, how a GST might be similar to the concepts you've talked about around an income tax, and why higher GST rates, what would they mean? How would they work? What would they be equivalent to?
Yeah, sure. Okay, so in the simplest possible model, you're right, might write down. I apologize for using models, but I'm an economist, so you'll have to deal with it. You are too. I mean the audience. In the simplest possible model, you have one period. There is no saving, right? Then if you have a flat labor income tax, everything taxed at 10%, it's equivalent to a consumption tax, because you can tax it when you earn it, or you can tax it when you spend it. There's no difference, right? There's the wedge between your labor effort and your consumption decisions, and it doesn't matter when I actually collect that money. But obviously that's no longer true if you have many periods and you have savings, because you're taxing the return to saving. And that's what we've been talking about this whole time, where there might be good reasons why you would have at least lower tax rates on savings compared to labor income, maybe even zero. I'm not particularly anchored on zero, but lower. And a GST pushes in that direction, because it's no longer equivalent to the labor income tax. And specifically, it's not equivalent precisely because it doesn't tax saving anymore. It just taxes final consumption. And so you earn your labor income when we tax you because you're a high earner. And then we apply some labor income tax to that. And then you save and you want to earn an undistorted return on your savings, etc. You decide when to consume, etc. But when you finally do consume, we hit you with the consumption tax. Then we didn't distort the decision of when to consume, because all consumption is taxed at the same rate. Another side point on this is that if you impose a capital tax and you distort the return to saving, etc., you actually make the whole of society less patient. And if you're worried about people not investing enough in Australia, the world's future, or mitigating climate change, or whatever it is, I'm not sure more impatience is what we want. So that gives you a reason to have low capital taxes. All right, so a GST then is, if you change the weight between a comprehensive income tax and a GST, you're effectively reducing the tax on savings. But otherwise, it's more or less equivalent. People also raise the idea that a GST is regressive relative in income tax, or really what's going on there is the comprehensive income tax is progressive and the GST is flat. But you can kind of get around that by saying, well, okay, if we move the weight between a comprehensive income tax to a GST, and that is more regressive than we started with, then we'll now make the labor income tax a little bit more progressive and we'll offset that difference. But the key difference economically is that we're no longer distorting savings as much as we were before. And it's interesting to see how many people, economists and otherwise, buy into this idea that commodity taxes, consumption taxes, or GST are good because they're efficient. But then on the other side, they say it's really important that we go with Haig-Simons, that labor income and capital income are treated the same. Well, the reason why GST is efficient is precisely a deviation from Haig-Simons, where we don't tax savings. So if you accept that efficiency gain, you're really accepting that Haig-Simons isn't the efficiency benchmark we thought it was.
Exactly. And I think like when you go back and you sort of read how people were talking about income in the 1920s and 30s, like the desire was to say, oh, well, how do we understand people's ability to pay? And they weren't thinking so much intertemporally, and they were just saying, oh, what's their ability to consume now? If they were able to consume and they were going to sacrifice some resources, and we're currently in like a certain situation, or we're going into a war, and we need to like get some way to provide right now, how do you do that? So you had this Haig-Simons concept. It's like a consumption plus what you could have consumed without eating into your wealth.
Yes, but it didn't get at that very well.
Yeah.
It was motivated in part by practicalities of what you can actually measure in things, and we've got better at that these days. But so there's another benchmark called Hicksian income. I don't know whether you've encountered this term, which makes the same adjustments but for labor income. And if you think about that, well, okay, so I'm earning a salary, and then I get promoted. So my labor income in the future goes up. Or a different thing that could happen is the interest rate goes down so that the present value of my future income, labor income, goes up. Well, then I should be taxed on that unrealized labor income gain, right? Just like we would tax unrealized capital gains. So I put this to a colleague the other day, and I said, oh, this sounds great to me, because then, if you really hate someone in your workplace, you promote them, and then we'll bankrupt them. But that's how you would do it symmetrically. Whereas Haig-Simons says, we're going to do this for capital income, but we're just going to ignore all of that for labor income.
Exactly. I remember there was a piece by Kaplow, I think, like describing like the taxation of human capital. And you essentially, someone goes to university and then comes out and they get struck with this huge tax liability. I'm sure it would be a treat if we were to start telling people about that.
Yeah, exactly. I mean, this comes up. Most people are relatively unsympathetic toward capital owners because they say, these people are rich. Well, not all capital owners are rich. And someone on Twitter was trying to tell me that young people saving for a house deposit don't have shares. I asked my students, for example, if they have shares. They're not super representative young people, but they certainly did. And lots of people do, because basically people across the distribution have it. And so they're less sympathetic about hitting these people with unrealized capital gains taxes, wealth taxes, and so on, because they kind of think if you're saving, if you have resources, then you're rich, and therefore I want to get you. But then edge cases come up, which are actually very common edge cases, so common that maybe they're not edge cases, where you have someone who's relatively they're not earning income, etc. They're a retiree, an old person living in a house. And if you start hitting them with taxes on the family home or unrealized capital gains taxes, etc., you force them to sell, you make them much worse off. You're going to take people who don't have the resources to pay a tax on an unrealized capital gain and force them to sell their company, for example. So it creates all kinds of problems, just like it would for a labor income earner.
Exactly. And I think it is interesting because, like, if you look back at the 70s or 80s, it felt like there were all these people criticizing tax authorities for doing things on realization and how it was a simplification. But they probably got closer to what we would view as an optimal tax system with that now than if we'd followed like the exact taxing Haig-Simons income as it accrues back then. If we ignore the fact that there hasn't been allowances for inflation, which is
I think that's right.
Pretty wild.
I like to think about the family home in this. So when I was younger and had less at stake, in part because I didn't own a house, etc., So maybe there's some bias built in here. But I used to think that we should obviously tax the family home if it appreciates. Right? You have more resources now. Your house went up in value. But a realized capital gains tax gets much closer to what I think we mean by well-being in that case, as far as I can see. Because imagine that we have a couple who have a home and they have 2 kids, etc., and they're planning to pass that house on to the kids. And it starts off as $100,000 house, and they're planning to pass on a $100,000 house to their kid. That's a $100,000 house, and they pass it on to their kids, etc., forever. And now suppose that whether it's interest rates went down in the 90s or whatever drove a big increase in house prices across the board, it's now $1 million house, but it's still the same house. I'm passing it on to my kids, and they have the same house, and they have, forever. No one's better off here, right? And so going after the unrealized capital gains seemed very unfair to me there. But now I'm in a different world where I had a $100,000 house and it went to $1 million, but I have no kids and I don't pass it on. And now I get to sell it and consume $900,000 before I die. Well, the capital gain sure benefited me, but it benefited me because I realized it and I consumed it.
Yeah, exactly.
So the realized capital gains tax is actually getting much better at a level of well-being that is relevant here than the unrealized one.
Yeah. No, precisely. I realized that I have taken you a bit over time by about 15 minutes. So we were definitely having a lot of fun, but we should wrap up there. Thanks for all the insights. It was wonderful.
This was fun. I learned a lot from talking to you. I hope you learned something from me as well. And I hope the audience learned something from both of us.
Well, I learned a lot from you, and I think the audience will have fun with it as well.